Happy Thursday, everybody. It is Thursday, July 22nd, and we're switching things up a little bit this week. We would normally have a podcast. This week, we are not going to have the Cash podcast. We've made some changes, and we are diverting our more, call it technical or our tech-heavy content and the more nerdy stuff, for lack of a better word, to our Libertas YouTube page. And we are going to continue to push more of the general financial education content, things having to do with financial planning, retirement planning, exit planning for business owners, 401ks, things of that nature. So general educational content. We're going to focus that on the podcast, the Cash podcast page. And going forward, we're going to try to spend less time being so technical at the request of our clients. But we're not going to stop doing it. We're going to continue providing you with the occasional update like the one that we're having here. I'm calling this a no huddle update because it's not a normal update that we would normally send out. And there's no reason to be concerned right now, by the way. But the reason we're doing this to this particular week is because this last, I would say, 4 or 5 months, we've had, as clients have come in to our office for meetings, or we've had some people saying things like, wow, this market's really crazy. It doesn't make a whole lot of sense. We've had some people who have their own portfolios that they manage on the side, and they've been saying how difficult it is to manage stocks, and manage a stock portfolio, and we've had some really, really fun conversations around that topic. We've had several people who are extremely concerned about inflation. They're concerned about the market getting top heavy. They're concerned about a correction or worse, a market crash in the near future. And so recently, literally just yesterday, we had a client email us. And it was the first time we'd heard somebody who was concerned about the overall market and the all-time highs that have been happening in, say, the Dow or the S&P 500, and then comparing that to, say, a diversified portfolio of stocks, whether that be large, mid, small cap, growth, value, and so on. And the concern that he had and the questions he had were so valid, I thought. And my response to him and the charts that I sent him, I thought were interesting enough to where I thought maybe it'd be worth sending an update to everybody. So let's go ahead and jump right into it here. First quote, I've got a quote today as always, and this is how it goes, and it's so pertinent to what's going on right now. And it goes like this: things are not always what they seem. The first appearance deceives many, and the intelligence of a few perceives what has been carefully hidden. And that's what we're talking about today, is what's hidden beneath the surface. We have an S&P 500 that's been going up based on the weight of a few stocks, mega cap stocks. And the same goes for the Dow. The Dow is obviously only 30 stocks, 30 very, very large stocks. So, and then we look at the Russell 2000, the small cap index. This is all small companies, 2,000 small cap stocks. And as you can see here, since February, it peaked, I believe it was the 12th of February. The Russell 2000 peaked along with several other indices. You can see it's just been chopping sideways. We're in basically a pressure cooker, or it's coiling, as we say in technical analysis. And the longer that the longer this pressure cooker cooks this thing back and forth, the bigger the breakout or the bigger the breakdown. The question is, of course, is it going to break out from here, or is it going to break down? But the fact of the matter, first and foremost, what I want to bring home here, the message I want to bring home, is that when you look at these 2,000 stocks compared to just the 505 on the S&P 500, we have 2,000 stocks right here that have done absolutely nothing but go down since February 12th of this year. And to answer the question of whether or not I think we are going to see a breakout to the upside or a breakdown to the downside, at least for now, when we look at momentum, and not to get too nerdy here, is because we have not seen momentum get below 30 on what's called relative strength index, or RSI, I think that is good evidence that suggests that we continue to hold this bottom line here in the sand. And as long as we continue to hold that bottom line and momentum stays in a bullish or positive regime, then I think that evidence suggests that the higher probability is that this base is a continuation pattern that continues to the upside. When I say continuation pattern, I mean it continues the prior trend, which was up. So we've got an up move here going the last half of last year. Then we have a bunch of sideways movement. And now I think that we should probably see this break out to the top side. Now, with that being said, if it doesn't, if it breaks down, then that's obviously telling us that the analysis is completely off and that the market has faked us out, and the chances are it would probably break down pretty heavily and pretty fast, and it would warrant some serious caution. Now, the next thing I want to show you, this is the Investors Business Daily Top 50 Growth Stocks. And so IBD has a momentum indicator. They have all these different indicators and screens that they use to build the top 50 growth stocks in their ETF, which is FFTY. And these are the top 50 growth stocks. And as you can see, again, I believe if I looked at the date on this, this would be February 12th. It has done nothing but go down since then. Now, I say nothing but go down. For those of you who are very literal, obviously this has been choppy. But the bottom line is when we look at the market this year, yes, the S&P's gone up, and yes, the Dow has gone up, but the stocks within the market, remember, we're talking about perception versus reality. We're talking about illusions or hallucinations maybe that the market is giving us that maybe aren't necessarily true. What we see beneath the surface is a completely different picture from what we're seeing in the major market indices in the S&P 500 and the Dow 30. So this is the IBD top 50 growth stocks that are down since February, and not down by a little, by the way. If we move on here, speaking of the S&P 500, here's an example of one of the reasons why the S&P 500 has continued to go up, even though a lot of stocks are down. Apple and Microsoft, when you look at the technology sector, and this is Yardeni Research, by the way, Apple and Microsoft alone, these two companies on the S&P 500, make up for 45% of the technology sector, the technology portion of the S&P 500. That is a huge amount of that sector. And so when we see Apple or Microsoft go up or down, then it's going to move the weight of the entire sector. Furthermore, if I move on here, this is Facebook, Apple, Amazon, Netflix, Google, and Microsoft. So what's called the FanMag stocks. They always change the acronym every year as these things change, or every couple of years anyway. But not all of these stocks have been performing well. In fact, Amazon and Netflix have not really been stellar, to be honest. But Facebook, Apple, Google, and Microsoft have been pulling up this market. And as you can see on the right side of the chart here, this line in the sand, or this line, this upward movement, is all the FanMag stocks, these big mega cap stocks that have been going up. The blue line is the total of the S&P 500, including those 6 stocks. And then this line right here, which has gone nowhere since, call it second quarter, and really hasn't been all that impressive since February. It's still at the same place it was in February. This does not include those handful of stocks. So what you're seeing here is the effect of a few big companies that represent a very large portion of the S&P 500, which, by the way, is 25%, pulling up the entire index and making it look a lot better than it is. And if you're wondering, well, why don't we just put all of our money into Microsoft, Apple, Google, and Facebook? Well, I mean, that's obviously not the safest thing to do in the world. And of course, you don't know that in advance, obviously, without hindsight at our advantage, we don't know that we're going to see a sprint like this, call it a 2, 3, 4 month sprint of any stock, let alone mega cap stocks like Microsoft, Google, Facebook, and Apple, until it's kind of already behind us in the rearview mirror. So, and it wouldn't make sense, obviously, to put all of our money, or anybody's money, all of their money, into a portfolio of 6 stocks, especially if you weren't watching it on a day-to-day basis with an exit strategy in mind and a way to get out should the sky start to fall. Most people don't have all their money invested in stocks, first and foremost. And then second of all, the market's going to go through periods of time where you have situations like this occur where, again, a handful of stocks brings up an entire index, while all the stocks, not all the stocks, but a majority of the stocks below the surface are declining in value. In fact, here's a chart of Amazon. Now, this chart goes all the way back to July of last year, so it's a 1-year chart. And you can see here, if I drew a line, and I didn't, but I should have, if I drew a line going back to September 1st of last year, Amazon is sitting at almost the same place as it was in September of last year, almost a year ago. If we look at Netflix. If we look at Netflix, the picture is even uglier. Not only is Netflix not done anything but it's actually down over the last 12 months. But it's also been extremely volatile. It's just been up and down and up and down. Just kind of, you see this, gap down here, a gap up there, a gap up here, a gap down there. So this has not been an easy market to invest money in, even though it might seem like if you look at the S&P 500 and just put all your money in the S&P this past year, that would have worked out. Now that doesn't work out every year, and again, I don't think most people would prefer to have all their money thrown into the Dow or the S&P and just to let it sit. And to make my point even clearer here, here's something else that I was sharing with someone else yesterday. This is the S&P 500, going back to December, which again, as you can see, it's been going up. Now, if you look at the percentage that the S&P as of yesterday was above its own 50-day trend line or 50-day moving average, it was 2.67% above this blue shaded area as of yesterday. But when you look at the 505 stocks within the S&P 500, only 46% of them are above this blue shaded area. In other words, 54% of the stocks on the S&P 500 are below their 50-day moving average or 50-day trend line. So what that tells us, first and foremost, is that most of these stocks are below what most would consider to be an intermediate term uptrend. In other words, they're below that line, not above it. And that's not good, obviously. The second thing I'll show you, and this is from my friend Andrew Thrasher, does great analysis. I often borrow a bunch of ideas from him, but this is kind of similar to the 50-day moving average, but instead we're looking at wins and losses. We're looking at drawdowns. So while the S&P has been up, you can see here that the percentage of stocks inside the S&P 500 that are down more than 10% is 47.5%. Almost half the stocks inside the S&P 500 are down 10% or more, never mind all-time highs. If you go down further than that, you can see here almost 14% of stocks in the S&P 500. So we're looking at the stocks underneath the surface, not just those big few companies that are pulling up the index. So almost 14% of stocks on the S&P 500 are down more than 20%, which is considered bear market territory or crash territory. So when we look at the market, we have to realize that what we're looking at doesn't always tell us the whole story. I always like to use the analogy of health and disease. And so when you look at a patient, when a doctor looks at a patient, that patient, he or she may look healthy on the outside, and they may feel like they're fine. But when you do a PET scan, or you do an MRI, or you do some sort of scan, and then you get this huge surprise that you've got this illness below the surface that you did not know about, that's analogous to what's been going on in the stock market this year. If we go to some positive evidence I thought I'd share, this is a Sentiment Trader, puts up great analysis. I subscribed. You have to be a subscriber to get this information. This is the Smart Money versus Dumb Money Index. Please don't take any offense to the fact that they call it smart and dumb money. What we're looking at is the difference between commercial hedgers. So the smart money is the big, huge institutions and commercial hedgers, and the dumb money is considered kind of the smaller speculators that aren't as experienced in the market. And they can get this information from a number of places, but primarily Commitment of Traders COT data. But anyway, I digress. So here's the S&P again in the top pane again, and what we're seeing here is an increase in the confidence of the smart money with a decrease in confidence of the dumb money. Now, the reason why I think we're seeing this is because underneath the surface, as the market corrects, and I know you're thinking, what do you mean? What do you mean correction? It's not correcting, it's going up. Well, again, the S&P is going up because of a few stocks, but the stocks within the stock market have been going down. There have been lots of divergences. There have been a lot of declining stocks, as I've just shown you in the last couple slides, that are either breaking their uptrends in a downtrend or already down 10 to 20% or more. So as this happens, the smart money becomes more and more confident that we've already seen what could turn out to be a washout. All it would take, let's just say, is the S&P breaking its own 50-day moving average, and then for the market to go down real quick or to see a multi-week correction, and then we'd find a bottom, and I think we'd be off to the races and headed off to a new resumption in highs. I don't see a market crash happening right now, and I think it's because we have low interest rates, we have stimulus on the horizon, and we also have bond buying in the credit markets, triple B and higher corporate bonds still being purchased on a weekly basis, and we also have the Fed, which is on our side. So I think that it would be extremely difficult for me anyway, and this is just my opinion, to see a market crash. Now, could we see a correction? I think that could be possible. In fact, I'll get to that in a second, but the next thing I want to show you is Lowry Research. I reached out to them today actually to ask for this chart, because this is, again, subscriber-only content, and I, of course, want to make sure I mention that this is Lowry Research's content. It's great stuff. The red line in the bottom here, the bottom pane, is what's called selling pressure. It's when there's selling enthusiasm, when there's more enthusiasm on the seller side than the buyer side, you see a rise in this red line. The black line is what's called buying power, and buying power is when there's lots of enthusiasm from buyers in the market. Now, what we obviously want to see in a healthy market is a rising black line, in other words, a rising buying power, and then we want to see declining selling pressure. And if you go back to the COVID crash, you can see here I drew a horizontal red dotted or red dashed line where selling pressure exceeded buying power. In other words, they crossed. And when that happened, then basically the sellers took control of the imbalance between supply and demand. So at that time, you can see when that occurred, and then the market kind of fell out and the bottom fell out. And it didn't take until, let's see here, this is almost June. So it looks like May before the selling pressure declined below buying power. Now, after that occurred, we started to see this descending in buying power as the market went up. Now, there's nothing wrong with seeing buying power go down as long as selling pressure is going down as well. It's when we start to see the opposite happen. So as you can see, this year so far, we've seen this descending buying power with descending selling pressure right up until about a couple months ago, when we started to see selling pressure tick up. And then literally just this past week, selling pressure exceeded buying power. And then just yesterday's market close, it whipsawed and buying power came right back in to the dominant position. So right now we're paying very close attention to, are we on the brink of what could turn into potentially a big drop in the market? Perhaps, potentially, maybe, we'll see. Or is this just a time when a lot of selling and a lot of declines in stocks have happened below the blankets, below the surface, that is a little bit harder to see unless you do more analysis like I've been showing you today? And if that's the case, then maybe this isn't going to turn out to be some big, huge correction or crash. Maybe it's just going to be a minor drop in the market. And that's what I want to finish on today. This is seasonality. Stock Traders Almanac does great research as well, and this is something I follow on a regular basis. And what you can see here, two things I want you to focus on, is this is the S&P 500 over since 1949, the average performance of the S&P 500 during the first year that a Democrat is president in office. And you can see here the total performance, pretty much kind of a smooth ride northward with maybe a little bit of choppiness in the fourth quarter, but generally, a movement upward of somewhere just above 10%. Conversely, the line at the bottom here is a post-election year, which is what we're living in right now. Just like we're living in the first year of a Democratic president, we're also living in the first year after an incumbent party loss. And it doesn't matter if it's a Democrat or a Republican. It's the first year after whoever the president was, the incumbent party lost, and it's the year after that. And you can see that it's kind of a decline It's a decline initially into the new year. And then in March, the market goes up on average until about late May, early June. Then the market declines until about early July, peaks again in August, declines through August and September, which, by the way, August and September are the two worst months for the stock market on average, with September being the worst month. And then you can see it accelerates through the fourth quarter and ends up about 2.1, 2.2% for the year. So the question is, these are averages, first of all, by the way, before I say the question is, these are just averages. This is not a prediction. The market doesn't have to do anything that these averages are doing. But as we look at this, it gives us some historical precedent, at least something to look at. And right now what we've seen is a S&P 500 led by a very small handful of big, huge mega cap stocks rising. So are we going to see that rise continue because the small caps and mid cap stocks and the other stocks in the market bring it up because they start to recover again? Or are we going to see the market head down for the next, say, month or two because those mega caps get exhausted, out of breath, and they want to take a break? And of course, we don't know. But that's where I go back to saying again, normally we would expect the months of August and September to be bad months, to where, down 2, 3, 4%. But for that to be temporary, because the best quarter of the year for the market is the fourth quarter. So we would expect to see a good quarter, and this isn't any year, by the way, having nothing to do with the election, post-election years, and so on. The fourth quarter tends to be really good in almost every year in the election cycle. So whatever we see, whether it's an uptrend and small caps and mid caps and the smaller stocks coming back up to pull the market higher and catching up to the mega caps, or the mega caps catching down, we'll say, before we see a resumption higher, I still think that what we'll see at the end of the day, even if we see a temporary drop in the market, a temporary, whether that's a pullback or a correction, by definition, a correction would be over 10%. I don't know. But whatever we see, I do believe that we still have the Fed on our side. We still have low interest rates and declining interest rates again, by the way. We still have stimulus on the horizon, especially on the infrastructure front. And again, we still have bond buying going into the corporate bond market like crazy on a weekly basis. So with that all being said, I hope you learned a couple things. If you have any questions for me, please feel free to reach out via email. You can reach us at info@libertaswealth.com if you have any interest in getting a second opinion on your retirement plan, your financial plan, your estate plan. Please let us know. That's what we do. We always say I haven't worked in 20 years. This does not work for me. It's a lot of fun, and I would be happy to answer any questions you have. We always say you never have to be a client to ask a question. So thanks so much for your time, and we'll see you next time.